Mutual fund basics. I have to confess, I have a partiality to mutual funds. Here's a couple of realities. Number one, I can get instant diversity without almost any serious investment in cash. I could put $10,000 into a mutual fund or 4 or 5 mutual funds and have a whole series of stocks and bonds available, 50, 60, 70 of them in a different portfolio, and I buy shares in the mutual funds, and all of a sudden now I have true financial diversity. I can have some in low capital, some in large cap risk. So it depends what it's all out there and what you're really focusing in on. So you get instant diversity, you get the ability to reinvest without even thinking about it. And on top of that, when it's you versus program trading, guess who's faster? I'll bet that computer or the artificial intelligence is probably faster than you, even on your nimblest day with your fingers on the keyboard. Yes, it's almost terrifying because of the fact you are up against a machine, and the machine is designed for one thing, and the one thing only is to sit down there, invest money, and make money, and make certain it makes more money than you make it. You might not win that contest. That's why I like mutual funds and ETFs, this whole section over here, and even RITs, RITs, if you want to focus in on that. But investment companies, they create portfolios that you can buy into. So mutual funds, ETFs, closed-end funds, unit investment trusts, really the most common is mutual funds. There's billions, trillions of dollars in mutual funds. Look at the chart we have over here. This is in trillions of dollars, $23.9 trillion in 2020, and it shifts and varies by each year. And you can see some of the other teeny tiny ones. Right after that comes ETFs or exchange traded funds. And then you have the teeny tiny closed-end funds, unit investment trust. So you really have those out there. The mutual fund is an open-end investment, and it's got a portfolio of different instruments. You buy shares into the mutual funds, and then the shares are created or sold. You don't have to buy a whole share, and there's no really having to buy 100 shares like you have to have with stocks where you get penalized for it. The reality is you can buy partial shares, and just depends what you want to put into it. And then you have a fund manager, and they give you a regular report on as often as you want on a monthly basis generally. So you look on the mutual fund, the net asset value, it's called NAV, okay? So it's a per share value of the stock. And here is the technical formula to figure out what you're involved with, how you can purchase the different shares. That said, you can really have an unlimited number of shares that are created in the process. You give money, and hopefully, if you have a good mutual fund manager, they're keeping you apprised. They're also taking advantage, and they're defining what the fund is all about. It's kind of a fun way of investing because of the fact if you want to sit down and get an Asian fund that focuses on textile industry in Asia, you can do that. And in the process, you have somebody out there watching it on a daily basis, minute by minute, buying, selling stocks and bonds for the best overall focus of the fund. If it's for large capitalization companies, it's buying stocks and bonds in different aspects of large companies. And it's a matter of textiles or electronics, whatever you want to focus in on, whatever topic, you will find a mutual fund out there. There's even some that track the actual indexes that we've already talked about. So pay attention. On this particular one, here's the Schwab Core Equity Fund. You can see over here what the overall cost is per share, and overall what the over expense ratio is, and the changes in the net expense rate and the year-to-date return. This is actually a negative 12.47 return, but you know what? Sometimes they go down. If you're patient, most mutual funds will pop back up. It's one of the better overall long-term economic tools, except for the fact you have to pay attention as to your mix. You can mix lots of different mutual funds that only have small portions of each one to diversify your overall portfolio. Here's an example here. Stocks value, bond values, how much you have in the whole process. You'll see the shifting of it as they go through from day 0, day 1, day 2. You'll see the value change and shift a little bit, how many shares you have. And overall, now you can see what's happening. You went from day 0 to day 3, 2, and so you now have $23.44 for the overall NAV. And now it's up a little bit, not much, but you're paying attention to how much a daily return is. So that happens on a daily basis. If you keep that up, you will sit down and start accumulating some decent wealth in the process. Always make certain you know how they're getting their money. They're not doing this because they're nice people. They might be nice people, but they're doing it to make money, and so are you. So find out How they do it, there's really three different ways they make it. A front-end load where you pay them at the time that you purchase into the fund. There's a back-end load, which means you don't pay anything up front, but you pay when you sell whatever you have in your mutual fund. You may sit there for 5 years and not take any money out of it and they don't receive any money off of it, but keep on trading. But as soon as you leave, you're going to give them a fee. Then you have a low load fund, which the loads, they charge you 1 to 3% in the whole process. Make certain that you're out there. A no load fund doesn't change the load at your purchase nor at the sale. You have to do your own research on it. In essence, low load means the fact that you better pay attention to what's going on there. So an asset-based fee sometimes is charged, and the fee is a percentage of the assets being managed if it sits for a while. So really have 5 different things to learn, but the key are front-end load, back-end load, and low load funds. Those are what you're going to be paying your main fees in there. Here's an example of a growth of a no-load mutual fund. Load and no load, you'll see the difference over here. The no loads are becoming huge, and you're relying upon yourself to make all the different changes in the process. So you'll see over here, the no load, the fund doesn't change the load at your purchase nor sell, and you have to do your own research in the process. The load fee, it's a percentage of the offer price rather than the NAV. So therefore, find the offer price, divide the NAV by 1 minus the load percentage. You can see the cost over here. So if it's 23.44 and the load's 2%, what's going to be the offer price? You figure it out over here. It's a little bit higher than the actual price, but not a great deal because it's only 2%. If you want to purchase a share, it's going to be this calculation over here. Regardless, if they're going to show you the purchase price on the different assets that you have over there. Sometimes there's holding fees. You'll have a management fee, and they charge that to operate the fund, and then it's got a marketing expense to it, and there's an expense ratio. So pay attention to how they're charging you and if there is a holding fee or not. Look it up online and find its NAV. Assume you invest $50,000 in the fund. What would happen? Assume an experience returns of 5 and 10%. And that is not uncommon. I've had mutual funds. I got so excited. I made 18% in 1 year, and it was spectacular. The next year, it actually did a 1.1% return. It wasn't that good. So sometimes they'll have their ups and downs, but it really depends upon all the conditions. If you're buying a mutual fund that focuses on the South American economy and the Brazilian economy tanks, all of a sudden now you have a problem because you had it over there. But maybe you sat there invested in the European mutual fund that focuses on the geography of what's going on in Europe, and all of a sudden now you make it up over there. So having that diversity and the ability to change it is really a big deal. So mutual funds are pre-made portfolios. You don't have to watch them every single minute for spikes or anything else. You can just sit down there and back up and relax and watch it and do shifts on a regular basis. And the sellers always have a fee. It's your job when you get into this to figure out what that fee is. Otherwise, you may be paying fees you never expected by the time you sell the funds or whichever process you have there, if there's a management fee as well. Know the fees, and life will be good. You'll have a decent portfolio balance with a lot of financial diversity, which is exactly what you want for your portfolio. Take care.